We are going to be talking on week to week mitigation today. Now, as a trader, you really need to know what this is so that it's going to save you a whole lot of stress, and then you're going to know where market is going next. You don't just start assuming, you don't just start predicting. You are waiting for the market to react at a particular point. You are not just predicting without a prior knowledge on where the market is going. Alright guys, if you are new to this channel, hit the subscribe button and turn on the notification bell to be notified whenever I drop a new video. You're welcome back to my video, guys. I'm going to be teaching on what we know as week to week mitigation. Week to week mitigation. I'm going to be using volatility 50 index. Alright guys, I make use of the derivative broker. So if you would also love to register with my broker where you can trade 24 hours in 7 days, you can check the description box to register with the link there. Okay, so like I said, we are going to be talking on week to week mitigation. When we talk about week to week mitigation, you must know what your external liquidity mean. You must definitely know what your external liquidity mean. So that's what I'm going to be explaining first before the week to week mitigation. I'm going to be explaining what your external liquidity mean. All right guys, when we talk about external liquidity, for instance, let's say we are in an uptrend. We are in an uptrend over here. All right, so where is our external liquidity? Where is our external liquidity? So as we are in an uptrend here, our external liquidity is always the low or the high we are expecting the market to take. That is our external liquidity, the low or the high that we are expecting the market to take. That is what we call our external liquidity. The low or the high you are expecting the market to take. Okay, so for instance, on this in an uptrend, the high we are expecting the market to take is our external liquidity. So this is our external liquidity. This high is our external liquidity. This particular high is our external liquidity. This high is an external liquidity. You know, we are in an uptrend and then we are expecting the market to keep violating the highs and not come back to violate the lows. Okay, so those lows are the major liquidity. We classify the lows as the major liquidity. Now we have characteristics of major liquidity, of which I have done. I've explained characteristics of major liquidity in my in one of my videos, and then I posted it on my YouTube channel, so you can check through for that. So we have characteristics of major liquidity. You don't just classify any low as major liquidity. You don't just say any low is a major liquidity, but the highs we are expecting the market to violate is our external liquidity. You are expecting the market to violate the highs. So in a downtrend also, you know, we are expecting the market to violate the lows in a downtrend. We are actually expecting the market to violate the lows in a downtrend. So that is what we classify as our external liquidity. That is what we classify as our external liquidity. The lows are the external liquidity. This low is an external liquidity. This low is an external liquidity. This is also an external liquidity. The lows are the external liquidity in a downtrend, while the highs are the external liquidity in an uptrend. So why the lows in an uptrend are what we classify as the major liquidity. So when markets violate the major liquidity, some people call it change of character, some people can call it break of market structure, or the market is about changing structure to the downside. Anyone you call it, but sometimes the market uses those low as inducement. So that is why you really need to know what characteristics of major liquidity are. You really need to know what characteristics of major liquidity are, so that the market does not just take any low and then you just feel that is a break of structure for you, or that is a real change of character for you. Okay, and sometimes the market might take a particular low and then it is going back to where we have void areas. It is going back to void areas, that is where the market has not tested before. So sometimes the markets might go back to where the market has not tested, to test it properly and continue in the trend. So all these are the things you really need to know, so that you don't just get to the wrong side of the market. The market breaks a particular low and takes it at an inducement, and then you're already classifying that as a break of structure. You really need to know about this. But here, what I just want to teach you here is external liquidity. We shouldn't be talking much on major liquidity. We shouldn't be talking much on that, because I already made a video concerning that. So the external liquidity, I really want you to get it, guys. In an uptrend, our external liquidity is the highs. In an uptrend, we are expecting the market to violate the highs and not the lows. So our external liquidity had the highs in an uptrend, while in a downtrend, our external liquidity are the lows. The external liquidity are the lows. Now let's go straight into what we call the week to week mitigation. Now, you don't expect market to return back to origin until we take our external liquidity. You don't expect the market to return back to origin until we take our external liquidity. Now, what does this mean? So let's assume we are in a downtrend. Okay, let's use a downtrend as an example. A downtrend as an example. So this is a downtrend. You will have structures like this when we are retracing back. You will have some structures like this. Okay, now this is it. The market does something like this. Now, what do we classify as origin? Done, guys. Okay, what do we classify as the origin? Now, when we talk about origin, this is the origin of the market. This area is the origin of the market, and this is where we have our sponsored candle. This area is where we have our sponsored candle. I think I need to mark that out with a rectangle. All right, this area is our origin. We are always saying our sponsored candle, and then we are always saying that market should actually come back to your support zone, to your resistance zone. All those things. This is how you expect market to move in a downtrend. Okay, that is how we've been taught. You are expecting the market to return back to a sponsored candle, which is around this area, before you take your trades. You are expecting it to come back to a significant resistance zone. You are expecting it to go back to a significant support zone before taking your trade, and that is what we call our origin. Okay, the market started selling from this high. So that is why we call it the origin. That is why we call that area our origin. The market started selling from that area. So that is why we classify it as the origin zone. And that origin zone is where we have our sponsored candle. we have our sponsored candle at that zone. When we talk about sponsored candle simply mean the last buy before a sell move. The last buy before a sell move, or the last sell candle before a buy move. That is what we just classified as our sponsored candle. It simply means that is the candle, that is the candle that sponsored the move. That is the candle that sponsored the move. That is what we classify as the sponsored candle. So at this origin zone, we have our sponsored candle there. Like I said earlier, you are not expecting the market to return back to the origin. That is, you are not expecting it to return back to the sponsored candle without taking your external liquidity. If you watch carefully here, guys, markets did not have strength to come back into the zone. Markets did not have that strength to come back into the zone, and it was using the structures that were created, the internal structures that were created in between the markets. The market was using those internal structure to continue the movement to the downside. I think I need to draw this more. Okay, the market was using this area. Now a lot of people are expecting the market to come back into this area before breaking this low. Remember, this is our external liquidity. We are in a downtrend, so this is our external liquidity. This low is our external liquidity. Now, until we break this particular low, you are expecting the market to do a week to week mitigation. And that week to week mitigation is what we classify as internal liquidity, such that when market takes out that external liquidity, market will come back to take the internal liquidity and return back to origin. That is exactly what you are expecting from the market. You are waiting for the market to do internal week to week mitigation. After breaking your external liquidity, then you are expecting it to return back to origin and continue the movement. The market will not do something like this always. Remember, we are always creating structures in between the markets, in between our structure range. We are always creating structures. So market is not just going to move this way. Market is not as straight as this. If market is as straight as this, a lot of people will make money. And in fact, everyone trading the financial markets will make a whole lot of money. But market does not move this straight. Market is not this straight. You are going to see a whole lot of structures in between the markets, in between the movements. You are going to see a whole lot of structures. So after the market has taken the external liquidity, you are not expecting it to move in this manner. You're expecting it to move in this manner. Go back to origin, come back to origin, then break structure again. Now, it's not just going to move this straight. In fact, some structures will move impulsively, but you are not expecting it to be this straight. There will still be some structures in between the markets, especially on the lower time frame. You will still see some structures in between the markets, especially on your lower time frame. So you are not expecting it to just move impulsively, boom, get into your to the SC candle, to the sponsored candle, and you are expecting it to just move impulsively. The market will not do that. It will create some other structures. We can have a structure like this, then we have something like this. Market comes back again, then it will use this area. Now you are not expecting market to take out this high, come back to this sponsored candle until we break this low. That is what I am calling the week to week mitigation. You are not expecting it to just come here, use this sponsored candle and continue to the downside. If the market breaks this particular high, it simply means we are raiding this high. If the market takes out this high, it simply means this high is no longer safe. Okay, so that is why we are not expecting the market to come back to this origin without taking this external liquidity. So market will do something like this, then come back to break external liquidity. Now this week to week mitigation that it has used, the markets will now come back to use it as a liquidity to come back to our sponsored candle again. So this has become a liquidity for the market. This is going to be the fuel for the market. So once market takes them out, comes back to origin, you see the market moving back impulsively to the downside. There will still be little structures created in between as external structure, and then some structures can be very smooth in such a way that it is going to test your SC candle before moving impulsively. It's going to test it this way and give you a shift in market structure. That is where we see a shift in market structure. Then we will have something like this again. We'll have something like this again. There are some moves that are very smooth. Then you have this again. Then you come back again. The market moves this way again. Then to the downside. Market comes back, and then that is the move. There are some structures that are smooth this way. There are some structures that are very smooth this way. But before taking an external liquidity, if you want to seek for a continuation, you are expecting the market to do a week to week mitigation. You are expecting the market to do a week to week mitigation. And when I talk about week to week mitigation, if you want to seek a continuation from the internal structure for us to take out the external liquidity, now we can have something like this. Okay, I've been using a downtrend, so let's use an uptrend for this example. So we can have this, then now if we have a break of minor structure, remember our minor structure are the structures that are created in a retracement. So if we have a break of minor structure at PO high, and then you want to seek a continuation to take out this high, you seek a continuation at a week to week mitigation, meaning you seek continuation at this low, you seek for continuation here, and then you are expecting it to take out this external liquidity. You're expecting it to take out the external liquidity. After we've taken out the external liquidity, the markets might use our resistance and then turn it into a support, which is our secondary PO high, and then continue movement. And sometimes the market will come back to our primary zone of interest and then continue to the upside. So when you want to seek for a continuation, to take out an external liquidity, you use the structures that has been created internally. You are not waiting for the market to get back to your sponsored candle before you take a trade. So sometimes markets might do something like this. You can see we moved away impulsively from the origin. So the market will come back and do something like this. It might not get back to origin, leaving this place as a void area. So if you want to take out this external liquidity, all you are just seeking for is a movement at this area. You're seeking for a continuation around this area. Market using a week to week to continue to the upside. And after you've taken out your external liquidity, you are expecting the market at your void area, making this area as a liquidity to be taken before the movement. I told my trading partner one time, I said it simply means liquidity taken as an expiry. Yes, liquidity taken as an expiry. So this liquidity being taken, the expiry is the external liquidity that will be taken. Also, a liquidity can be taken here. The expiry is the external liquidity that will be taken. So that is why market takes a lot of people out of the market. So I'm going to be using charts now for this explanation, and I'm just going to round up. So I will be using a chart for this explanation. I need to turn on this. Okay. All right, guys. So let's use okay. This is the 30 minutes time frame. This is the 30 minutes time frame. Now, this is our external liquidity. Okay. Let me look for a perfect example for us, which I can get on the 4 hours time frame. The 30 minutes and the lower time frame has a whole lot of noise. Okay. It has a whole lot of noise. Okay, I think this is a perfect example for this. Now, guys, when we got to this area, look at this properly. We got to this area, market tested this area, and you can see that market could not come back into this area until we broke this low. Market could not come back into this internal area until we took out this low. This is the external liquidity for this range. This is the external liquidity for this range. After we took out this range, the market came back into the sponsored candle before movement. Now, it is not as if market has not been creating structures to move to the downside. Check this properly, guys. You can see we had void area here. We had void area here. We had void area here. But the market did not have strength to come back into this void area until we break our external liquidity. You can see what the market was using. We had a break of structure here. We had a break of structure to the downside here. Market came back and used this week to week mitigation. It used this structure. It used this range to continue to the downside. Now, it was after we've taken out our external liquidity, which is this. That was when market had the strength to come back into this area, to come back into this sponsored candle. It was until we took out this low, we had strength to come back into this candle. Also, let me show an example of this. Now, we had, if you check this properly, guys, market could not come back into this area. Market could not come back into this void area. And you can see we have an untested area here. This is an untested area that we really need to mark out. This is an untested area. Now, what is going to validate the market coming back into this area? What is going to validate market coming back into this area? Because you can see there was no strength for this move to come back into this area before we had a break of structure again. Now, after we had this break of structure, market started using this range to continue to the downside until we took out this low. Now, the validation to come back into this structure is we are going to break this external liquidity. Now, after we've taken this external liquidity, market can continue movement to the downside, but that does not simply mean market is not going to come back into this area. We still have a void area here. In fact, any other thing the market is going to be doing is range structure. It is what we call the range structure. So market has been making range structure, but we've taken external liquidity for this low. We've been making range structure. Now, when market will come back to this area to break this high, if market is going to come back to break this high, then we are going to come back into this area for a test, and the market will continue to the downside. You can see we have this untested zone here. The sponsored candle has not been tested, so every other things the market is making here is just a range structure. All these are just range structure. When market is going to come back fully, it is going to come back to test the origin that has not been tested. Using all this week to week mitigation, it will use all this week to week mitigation as liquidity. Some people will call it trend line liquidity. Some people will call this area trend line liquidity. Yes, some people will call it trend line liquidity. But all that matters is that market will return back to origin to test it. after we've taken our external liquidity. So you can see we've taken the external liquidity for that range. This is the external liquidity for that range. So we are expecting it to come back into this area and continue movement to the downside. It will come back to its origin, then use all of this as liquidity fuel. It's going to use this as a fuel to continue to the downside. You can see markets will definitely take all these areas, and then it will take a whole lot of traders out, because a lot of people has been placing their stop loss here. A lot of people will place their stop loss here at this eye, at this eye. A lot of people will place their stop loss there. But when market decides to come back into its origin, it will take out all those week to week mitigation and come back to the external and come back to the origin of the market. It will come back to the origin of the market before it continues its movement, and that is why you are going to see it on the daily time frame as a proper structure. It's going to appear as a proper structure on the daily time frame. This is 4 hours time frame. It's going to appear as a proper structure on the daily time frame and on the weekly time frame. And that is why on the weekly time frame you are going to see a good retracement, or on the daily time frame you will see a good retracement. That is when market is coming back to its origin. It will use all this week to week mitigation. You can see the market was using all this area. You can see we had BMS, which is the internal structure BMS. Market came back to an area here. We had another BMS here, and then market came back to this area. In fact, if we break this low, after we've taken out this low, this movement could actually come back and come back to origin. Yes, this movement can actually come back to origin. It can come back to origin. This particular movement, this particular move can come back to origin. It can come back to origin because that is after we've taken our external liquidity. It can come back to origin, taking all this week to week as liquidity, taking it as liquidity. So I hope you've been able to get something from this video, guys. If you have any question, drop it in the comment section. I'm going to attend to all questions, and I'm going to enlighten you more on what you need to know about it, or about your question. This is going to be all for now, guys. I'm going to see you in the next video. Keep living in the atmosphere of profits. Have a lovely trading day, guys.